Hello, today is Wednesday, March 31st, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Wilms, and I'm the President and CEO of the Milwaukee Company. And joining me today is Jim Picerno, the Milwaukee Company's Director of Analytics and the author of several books on finance and the editor of the well-known and highly respected Capital Spectator blog. Hi, Jim.
Hello, Andy.
Thank you for joining us again today.
Glad to be here.
Today, we're going to be discussing whether inflation is about to take off, and if time permits, I'll also ask Jim for his thoughts about real-time indications that can help us identify when the risk of a stock market bubble is unusually high, and if that is the case, what we can do about it. But before we get started, I'd like everybody to please keep in mind that this podcast is for informational purposes only, and that listeners should conduct their own independent research before acting on any information or opinions expressed during this podcast, and that the views expressed today are Jim and my personal views, and not necessarily those of the Milwaukee Company. So, Jim, let's begin by discussing inflation. There's been a lot of talk on Wall Street that inflation might be about to awaken from its decades-long slumber. What do you see as the cause for these concerns now?
Well, there are three key factors that are convincing quite a lot of people that inflation is going to heat up. One is the ongoing monetary stimulus from the Federal Reserve. That's sort of old news. It's been around for many years, pretty much more or less since the great financial crisis in 2008, 2009. That's ongoing and arguably is even stronger than it has been in the last decade. The other big change is the fiscal stimulus. The Biden administration has passed a $1.9 trillion relief/stimulus package, and there's talk of a $3 trillion infrastructure stimulus package. So there's a lot of money coming out of the Congress and the White House in Washington. And on top of that is the sort of natural springback from the pandemic. Obviously, the economy took a big hit last year. It's coming back. So those three factors combined are certainly leading to a reflation relative to where we had been over the last 6 to 12 months. The question is does that reflation continue and spill over and become something more, an extended run of higher inflation? That's the critical question.
Right, and in that third issue, with the economy springing back, I think part of that discussion would also include the fact that there's a great deal of pent-up consumer demand, and as a result of the, partly result of the $5 trillion total that the Congress has spent, there's a high amount of money sitting in consumers' bank accounts. And so at some point, the question is, are consumers going to start tapping into those reserves and start some additional discretionary spending that was put on hold for the last year or so during the pandemic? If so, that could at least be a short-term spike, lead to a short-term spike in inflation. Now, you mentioned reflation versus inflation. You want to clarify the distinction in your mind between those two?
Sure. I mean, reflation is a reference to the fact that we got disinflation, deflation for a short time last year when the coronavirus crisis first struck. Back in March, April, May, the economy crashed in every sense of the word, and tens of millions of people were thrown out of work through no fault of their own, and a lot of demand just sort of dried up, and you got outright deflation for a period. So as that situation is normalized, the normal pricing pressure that's always in the economy has come back, and so we're getting some reflation. And as those deflationary numbers from last year sort of fall out of the year-over-year comparisons in the inflation data, you'll see a pop up in inflation rates. What happens beyond this bounce back in inflation is the real question, and depending on your perspective and the numbers you're looking at, there's quite a debate on Wall Street about where we go from here. But that's where we stand at the moment.
So when we're talking about reflation, we're kind of talking about returning to that level of inflation that the Federal Reserve regards as healthy, which is like, basically around 2% a year. That's sort of what the Federal Reserve is targeting. And the Federal Reserve recently has said it's prepared to let inflation go above the 2% mark, as long as that's keeping the long-term average of inflation over the last several years to approximately a 2% level. And when we're talking about inflation, we're saying that would be inflation above the target rate of around 2%. Is that a fair depiction of it in your mind?
Yeah, that's exactly right. I mean, the Fed has said that they want to allow for some catch-up inflation, if you will, because inflation has been unusually low, so-called lowflation, for a number of years, and they do target around 2% for inflation, and it's fallen short of that. So the theory is that if the Fed lets inflation run hot for a while above 2%, assuming it gets to that point, and just let it run without preemptively trying to pull it back, then you'll get some catch-up inflation. The question is whether this is going to work as expected. There's a lot of talk about, the Fed is no longer worried about inflation, and they're not going to preemptively try and pull it back. They're going to react, so to speak. And so by letting it run hot, the question is do you run the risk of letting it run out of control? Because this is something new for the Fed. They've never really, since the 70s at least, I mean, the current era of Federal Reserve and central banking in the United States is to sort of keep inflation on a short leash. And that's been the game plan for a couple of decades at least. Now we're ending that. And so what happens next? It all looks good on paper, but people who are worried about inflation are saying that this is an experiment that could go wrong, but we'll see.
Well, I think that's right. And, you bring back you mentioned the late 70s, early 80s when Chairman Volcker was at the Fed. And, at that time, inflation had soared to 1% a month. And you and I are old enough to remember that he pushed the prime rate to 21.5% to try and get inflation under control. And so this is the risk. You've got to be really careful when you're playing with fire, because once inflation gets out of control, it gets to be very hard to bring it back under control. And Chairman Volcker was really, fortunately, had the fortitude to do it. Now, he had to push the economy into a recession to bring inflation under control, and he did that knowingly. I don't think at this point there's not many people suggesting that we're going to see the runaway inflation rates that we saw in the 70s anytime soon. But as you said, these factors have led some people on Wall Street to be concerned about inflation in ways that we haven't seen in quite some time. But there are others that are saying that inflation isn't likely to rise significantly for the foreseeable future. Yes, we might have a spike like you would normally expect after, when you have this kind of economic recovery going on. But that's all that's likely to be. We might spike above it for a little while, higher, but then eventually we should settle back down to the 2% range or so pretty quickly. And this seems to be the position of the Fed. They're saying we're not really concerned about inflation going above our 2% target, because we don't think there's enough reason for it to be worried that it's going to be the high rates of inflation would be sustained. What do you think about the Fed's position on this? Do you tend to agree with them or disagree?
I tend to expect, and again, these are all forecasts, as nobody really knows what's going to happen. But
Right.
I tend to expect that inflation will certainly pick up. Whether we get much above 2% on a sustained basis uh, uh, anytime soon, I'm open to the possibility, but I don't see it in the data. And the question is how hot does the economy really run? And a critical factor would be you'd see sort of a wage inflation really pick up, and you've seen a little bit of that so far, but with so many people still out of work and so many questions about what the post-pandemic economy is going to look like and how many people are going to go back to work and related issues, um, it keeps me a little bit skeptical that we're going to see inflation really break out to something we haven't seen in say a decade or so. I mean, there's other factors that still that are sort of disinflationary that haven't gone away. I mean, the aging workforce. There's technology. There's a global savings glut still. I mean, the demand for cash and safety is still sky high around the world. But if in fact there's something going to break here, something's going to change, we'll probably see strong evidence of it or not in the second half of this year. But right now, inflation is still pretty tame. We'll see what happens. There's a lot of factors swirling about, so it's not really clear what the next gig is.
Yeah, I agree with you to some extent, but I have a little more concern about the potential for high rates of inflation. I think you're right. It is clearly an experiment. And and that to me implies a realistic possibility that something could go wrong, right? Otherwise, it wouldn't be an experiment. And so, my sort of take on it is that the current and proposed government stimulus that will keep the economy just awash in cash for the next year or two or three. And because consumers have increased savings and there's a lot of dry powder in the consumers for spending, and they're going to get even more money in this next stimulus program. It's going to lead to increased spending by consumers, and you have at the same time the successful vaccines, which are going to, I think, lead to more normal activity. So you could see this surge in activity, I think, sometime around August. So you take more government cash plus a central bank that's committed to lower rates, plus consumers who want to spend, plus a reopening of closed businesses. I think that's going to lead to a spike in inflation with higher rates, well above what the Fed would normally target. The question becomes how long that will last, and I think I don't know the answer to that question because I don't know what the policies that the Congress and the Fed will adopt. If the Fed keeps its low rate policies too long and Congress does nothing to rein in the deficit, I think rates could soar well above the 2% Fed rate targets, and it will be more than just a spike. It could be a sustained period of time where inflation rates are well above 2%. And if that happens, it could take the drastic government action to bring inflation under control. If, on the other hand, the Fed, is timely about cutting back on this quantitative easing, and the Congress does take constructive steps to rein in the deficit, then I think we'll be okay. We won't see inflation going much higher. But I personally just have never bought into this modern monetary theory concept that deficits don't necessarily matter. I think, the size of the deficit is a very important part of what to expect in terms of inflation. And, it's true, your spending isn't going, people haven't been spending as much, but I'm not sure that that's a permanent condition. I think that's more a reflection of the coronavirus impacting what people are doing than it is about a change of heart. I don't think America's got all of a sudden adopted the mentality that we should be saving more for our future. But that would be a great thing if it were the case. But I'm skeptical of that. Well, let's assume that for the sake of discussion, if we expect inflation to go higher and interest rates to be rising, what would you be advising investors to do at this time? Would you just tell them to stay the course because you don't think the inflation problem is all that long lasting? Or would you tell our listeners to maybe become a little more defensive, and if so, how?
Well, if inflation is going higher, and even if it's sustainable, let's go out on a limb here and say inflation is going to pop up to 2, 3, 4% for the foreseeable future. That's still well short of that inflationary period in the 70s when you had sort of runaway inflation. I would expect that any inflationary run we have in the next several years would be sort of gradual. It wouldn't be a spike. It wouldn't be runaway inflation, and so stocks can probably do quite well with that. And I'm assuming that within a key driver of higher inflation is that the economy is humming along quite nicely. It's hard to see inflation really picking up if the economy is just sort of poking along at a modest rate. But if the economy is really humming and inflation picks up a little bit, stocks can still do quite well. On the bond side, higher inflation implies that rates will go up. So investors may want to embrace something along a laddering kind of strategy where you're slowly turning over capital to the higher rates as they come along and redeem expiring bonds and try and take advantage of that and hedge it a little bit. But what I wouldn't do at this point is go way out long on the curve and bet the farm on, say, 20, 30-year treasuries. I mean, they could really be hurt quite deeply if rates continue to rise.
Well, I agree with that entirely. And I would point out that in the 70s, when we look back at what caused those incredibly high rates of inflation in the 70s, many of those conditions are present now, right? I mean, it was the adoption was getting off the gold standard. Richard Nixon pulled us off the gold standard. That was a contributing factor. Of course, we're not on the gold standard now. You had the adoption of the Keynesian economics, which was really a big contributor to the thing, Keynesian economics basically stands for the proposition that government should use deficits to help ward off recessions and depressions. And that's certainly what we're doing now, but to a much greater extent than we did before. And it was a lot of it was political considerations. Nixon didn't want to see another recession interfere with his chances of getting reelected. So, all those things, nobody thought that we were going to get the inflation rates that we did in the 70s before they happened, right? There weren't a lot of canaries in the coal mine. So I do think, and I'm not saying it's going to happen, right? I think odds are against it. I think the chances of returning to, super high inflation rates, certainly double-digit inflation rates, are quite small. I don't think that's likely to happen at all, but I do think there is a realistic possibility that we could see higher inflation rates for longer. And so maybe I would keep that in my mind if I was an investor. And like you pointed out, in terms of bonds, I think it's a good idea to stay shorter on the curve, so your shorter term bonds that mature more quickly. I think you might want, and then you can be reinvested again at the proceeds reinvested at higher rates. Bond investors might also want to take a closer look at using a ladder strategy for maybe over a 5-year period. They might want to look at some floating rate notes where where the interest rate on the note gets adjusted to reflect changes in interest rates. And you might think about investing in individual bonds over bond ETFs, because even when rates go up with an individual bond, you get exactly what you were told you would get when you bought the bond. Whereas with an ETF, when rates go up, you could end up having to sell your shares at a much lower price. On the equity side, it seems to me there are certain areas, if you're thinking rates might go up, that you would want to have a tilt towards. Value stocks, financials, consumer discretionary stocks, energy stocks. Those are all sectors that tend to outperform during rising interest rates environments. But the key point, and the one I know that you and I both agree on, is that you don't want to place a big bet on either one of those two, either interest rates going up or inflation rates going up or inflation rates going down. You want to keep your risk level so you're consistent throughout your investment time frame. And to do that, that might require a little tactical asset allocation in the portfolio. But drastic measures like abandoning the bond market altogether, I think it would be a mistake. So
I agree. I agree.
So, okay, well, I guess that'll take care of it for today, Jim. I'm going to thank you for joining me.
Good to be here, Andy.
And I also want to thank our listeners for listening in and remind them that they should not act on anything they have heard in this podcast until you have discussed it with a qualified financial professional who is familiar with your personal situation and your investment objectives. And with that, I'll say thank you very much again and have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.